What's up, guys? I'm Jason from Financial Snowball, and today we're going to be talking about the most important metric in your life, your credit score. The credit score is the most underutilized number in a person's life, and if you ignore it, it can do catastrophic things to your ability to live your life of your dreams. It is absolutely imperative that every single person understand what their credit score is and learn how to boost it quickly. Welcome to the topic of this video. Because I really want to drive this point home, here are 3 places your credit score is used, and if it's not good, where you will not be able to move forward in your life. You're going to get a job, you find the perfect job, perfect opportunity for you, your skill set aligns, you go to the interview and you nail it, but you don't get the job. Because your employer did a credit check and found out that you can't pay your bills on time. And if you can't do that, how can you show up to work on time? A second place that's going to bug you is when you go to rent or buy a place to live. When you rent, most landlords are going to check your credit. Do you have a good history of paying people? They like to get paid on time. So if you have a poor credit score, someone else is going to get your dream apartment. You go to get a loan and you get a mortgage or a car, your interest rate can be double or triple what someone else would qualify on the same loan simply because you have a poor credit score. And that's silly. Because understanding what it is and how to do it through automation and education, you can literally save yourself thousands of dollars in not a lot of time. So let's jump into what your credit score is. Your credit history is made up of 5 metrics. Your payment history, your credit utilization, your credit history, your credit mix, and credit inquiries. And we'll jump into what each of these 5 is in a minute and what you can do today to boost them. Your credit score is an aggregate of these metrics into one number between 300 and 900. 300 being awful, 900 being incredible. You start at around 600 and it's generally accepted that anything over 740, 750 is an excellent credit score. There are 2 companies in Canada who are responsible for tracking your credit score, and it's your responsibility to look at your credit report and dispute any errors. That's right. A clerical error could be the reason why you don't get your dream job. So it is critical to look up your credit score and find out if there is an error on your account that can be fixed. You can do this by either going to Credit Karma or Borrowell. These are 2 free platforms that use each of the 2 companies that track your credit score. And through these companies, you can look at your credit report and find out if there's any errors. Dispute them immediately. But no one's only half the battle, so let's jump into what are the 5 metrics and what you can do to boost them quickly. The number 1 metric is your payment history. Do you pay your bills on time? This one is hard to game, but it's very easy to do. Simply pay all your bills and the amount that's required on time. And don't think that you're going to do this consistently for the next 50 years. Automate it. Make them pay themselves. Set up a pre-authorized debit on each one of your payment accounts for the full amount. That way your payment history is no longer on you. It is on the automation system in your financial life to get you 100% of this score. If you do miss a payment but you have a long history of paying on time, call up the company you missed a payment with immediately and try to get them to remove this from your credit report. This is possible. A lot of companies want to work with you to keep your credit score perfect. So if you miss one payment by a day, call them up immediately, say, oops, my bad, can you fix this? And get that off your credit report. Number 2 metric of your credit score is your credit utilization. This is going to be the most complicated metric on this list and the one that most Canadians get wrong. I've even seen other YouTubers here talking like they know what this is and explaining it absolutely incorrectly. This metric is the total amount of credit you have available to you. So if you have 3 credit cards with $5,000 on each card, you have $15,000 available to you versus the total amount you are using. If you have an average balance on your credit cards of $1,000, $1,000 divided by $15,000 is your credit utilization rate. And the goal is to keep that number as low as possible. Experts recommend under 30%. To be clear, with your credit utilization rate, it is not the amount that you owe per card. It's the total amount you have open versus the total amount you are using. I've seen people say that they have a credit card with $1,000 balance and they have a couple other credit cards, but they want to keep that $1,000 balance so small because they think it's a proportion of that one credit line. And this couldn't be farther from the truth. It's the total amount available to you versus the total amount you're using. So to game this metric, the best thing you can do, as funny as it sounds, is have more credit available to you. I always advocate to have your bills pay themselves off in full at the end of every month. So what you want to do is you want to look at the average spending you spend in a month. Let's say it's $1,000, and make sure you have more than enough available to you that doesn't raise your credit utilization rate. So if you spend $1,000 on average a month and you want it to be lower than 30%, you need to have at least $3,300 available in credit to you. Or even better, $10,000 available to you and you have 10% available. So the best way to gain this metric is to open up a new credit card. I've found that BMO is quite generous with the credit limits that they allow. So if you get a no fee, and check out my best no fee credit card video here, card from BMO with a high credit limit, you are immediately going to lower your credit utilization rate simply by having an extra credit card. Before you run out and get a new credit card to lower your credit utilization rate, you have to consider the effect on the other parts of your credit score. Put simply, if you have a loan you're planning on taking out, whether it be a mortgage or a car loan in the next year, you're going to want to avoid this in the short term and just pay off your balance more quickly in order to lower your utilization rate. But if you don't, there is no downside to opening up more no-fee credit lines, like credit cards or lines of credit, assuming that you're responsible with these lines, because it will absolutely impact your credit utilization rate, which is a large portion of your score. So if you have some comp in the short term, don't do it. If you don't have any plans for the next year or so to take out another loan, definitely consider opening up new credit cards and lines of credit to lower your utilization rate. You'll be thankful in the long run you did. Metric number 3 of your credit score is your credit history. This is exactly why you have to consider the short-term effects of taking out a new credit card or line of credit. Your credit history is the average age of all of your credit lines. If you have one credit card and you've had it for 30 years, the average age of your credit history is 30 years. If after 30 years you take out another credit card, your average age is now 15 years. Do you see what happened there? 30 years of credit plus 0 years of credit is now in half, 15. So to game this metric early in life, you want to take out several no-fee credit options to anchor your credit history at the large end, the long life that you're going to have. And you're not going to have such an impact when you take out a new credit card or line of credit or mortgage later in life, because your average age of credit is going to be anchored to the beginning of when you started your credit journey. This is especially important when you're considering canceling a credit card. If you cancel a credit card that you've had for 10 years, you are losing 10 years of credit history on your account. If a credit card has no annual fee and you're paying it off on time, just put one candy transaction a year on the card to keep it open and keep open that credit history. Do not ever cancel a no-fee credit card unless you have an extremely good reason not to, because it's going to hurt the credit history part of your credit score. Metric number 4 of your credit score is your credit mix. This one, thankfully, is much simpler and doesn't involve any math to understand. If you just have credit cards, you have a bad credit mix. If you have credit cards and a line of credit, you're getting better. If you have credit card, line of credit, mortgage, car loan, or other ways of taking out credit, you have an excellent credit mix. What this metric is looking to find out is whether you can handle different types of credit. So, if you only have one credit card and you're 19 and you just use it to pay gas and your other purchases, consider getting a free line of credit from your financial institution to increase your credit mix, because you'll then be seen as more credit worthy by having 2 different types of revolving credit on your credit history. So just make sure you diversify your credit lines. Metric number 5 of your credit score is credit inquiries. This one is again simple, and it's broken out into 2 areas: hard inquiries and soft inquiries. A hard inquiry is when you try to open up a new credit card, a new loan, you try to get a mortgage. A hard inquiry is going to damage your credit score in the short term a little bit as you're looking at your credit journey. You got to think of it from a bank's perspective. If you are going to try to get a mortgage and they can see that you've tried to apply for 20 credit cards in the last month, red flag, right? So you want to spread out your credit applications over a 3 to 6 month period between them. For soft inquiries, that's different. If you're checking on Credit Karma or Borrowell to see what your credit score is, doesn't affect your credit score. If someone offers you a soft inquiry to see where you are, doesn't affect your credit score, there's no reason not to do it. But those hard inquiries, like trying to take out a new credit card or a new line of credit or a mortgage or a car loan, be very careful about, because if you have a lot of those in a short period of time, that's a red flag. Special note here, if you're going to get a mortgage and they're checking your credit score with hard inquiries with several financial institutions in a very short period of time, they're going to put all of that together into one hard inquiry for you. They understand that if you're looking for a mortgage, you're not taking it out one try, you're going to check lots of institutions. So don't worry if you're in a very short period of time shopping around to get the best deal, that's going to be aggregated on your credit score. Just try not to do that too often. With that being said, you guys, I hope you learned what the 5 metrics are on your credit score, and you learned that you can automate your payments, keep a low balance, open up multiple credit cards earlier in your life, and smash the like button for the YouTube algorithm to help me grow this channel. And all those things are going to help your credit score. Okay, that last one's not going to help, but it will very much help my channel grow and reach my goal of helping bridge the financial literacy gap in Canada through automation and education. If that's something that you're interested in, please subscribe to this channel and comment down below. Let me know what you have learned about your credit score, or if you have any stories to share with other Canadians about credit scores. Thank you so much for watching, and I will see you next time.